Next one on the list is E29. E29 indicates Home Comfort Furniture Company completed 4 transactions with the dollar effects indicated below. It gives us some information that I've rewritten up here, and basically what it wants us to do, at least for the first requirement, is by looking at this information, looking at the dollar amounts and how they affect each one of these accounts we have listed up here, they want us to assume what is it that happened? What was the event that occurred that would produce these types of dollar impacts, okay? So the first one, looking at this, we say that we have cash has been increased by 12,000 and contributed capital has been increased by 12,000. Your answer for this one should be that we issued stock, and we practice this in a few of the other problems that we've done here. But you would increase contributed capital. Why? Think about what the words are. Contributed capital. Capital that's been contributed. We sold stock, and that's why we increased cash. What did we sell stock for? We didn't sell it for fun. We sold it for cash, right? We got cash. So cash is increased and contributed capital is increased, or stock is increased. And we'll talk more about the breakdown of contributed capital, because we can break down contributed capital into subcomponents here, but that doesn't come until chapter 11. So for right now, you can just think of it as this one account here. The next one, we have 50 is increased in cash and 50 increased in notes payable. In this instance, if we've increased cash and the other side of the equation is that a liability is increased, more specifically a notes payable that has principal and interest associated with it, then that means we have borrowed. We have borrowed 50,000 in cash, okay, and we owe a liability now, okay? So we've now borrowed, by signing a note, we've now borrowed 50,000 in cash. The next one is we've decreased cash by 4, increased equipment by 12, and then increased the liability by 8. Well, this sounds familiar because it's a lot like one of the problems we did as well. In this instance, we have increased our equipment, so we received equipment. It looks like we purchased equipment, right? How did we pay for that purchase? Well, we paid 4,000 in cash, and that's why cash is decreasing by 4,000. And then we also signed a notes payable for 8,000 here, okay? So we have a liability that's increased, we paid portion in cash, and then we received our equipment, okay? A lot like you can think of it by you making a down payment on a car. You go to a car dealership, you get equipment, a car, right? You pay a portion as a down payment in cash, and then you receive a liability, or you sign a loan that says you'll pay it back. Does that make sense? Okay. Next one is we increase cash by 4,000, and then we increase notes payable by 4,000. In this instance, we have borrowed again. We've increased our cash by signing a note that says we'll pay back principal and interest. The next requirement in this problem indicates they want us to compute the ending balance in each account. When we say ending balance, what we mean in accounting is we want to know what is the total of all the effects in this account, okay? Since they're listed out for us, it's just a simple event of summing up all the numbers that we have here, okay? So when we add these up here, we get 62,000 for cash, we get 12,000 in equipment, we get 62,000 here for notes payable, and we get 12,000 in contributed capital when we sum these up. Notice that the left side of the equation, cash and equipment's on the left side, equals that 62 and 12, equals the right side of the equation, the liabilities and stockholders' equity, which is 62 and 12 as well, okay? The last requirement of this problem says, has most of the financing for Home Comfort's investments come from liabilities or stockholders' equity? Well, now that we've analyzed the effects of those events and which transactions these were all recordable, but the recordable transactions and what effect they've had on the accounting equation here, we simply need to look and say, well, which one have we taken out more of? Which one have we increased more of? In this instance, for liabilities, we borrowed via a liability 62,000 here, and we only sold 12,000 in stock. Notice that this side of the equation has financed this side of the equation. Does that make sense here? We used this over here to get this and to get this. Does that make sense? Now you'd obviously have more transactions that take place in a business, and eventually all of this financing should relate into the income statement and generate a profit, right? But just looking at this example that we have here, we use this to finance this over here. Obviously most of the financing came through debt via notes payable, so 62,000 here, notes payable or liabilities is where the majority of the financing came from. If you have any questions on this problem, please feel free to email me. Thanks.